Alright, hi guys, so we're here for episode 2 of home buying in New Zealand, and today's episode is about debt and serviceability. So a lot of the time I get questions around, can I have debt and still get a mortgage? It is really case by case, there is no yes or no answer, and as you guys know, I'm not a qualified financial advisor, so I probably couldn't tell you even if I tried. So with debt and serviceability, when you go to a bank to take out a mortgage, what the bank want to be able to see is that you have enough income to be able to service a mortgage, plus the regular payments that you currently already have outgoing. So I've done a little bit of a picture here with my handy dandy whiteboard. So this is the bank. They will have a look at your incoming, so there is wages, any other means. I have put here, and it is kind of the case for if you are employed, if you've got a stable employer, that they kind of want to see very stable income. So I know for my husband's self-employment, they do normally ask for like 1 to 2 years worth of income. Obviously it's case by case, so if your employer writes you a letter of recommendation or your business might be doing really well, I would still take all of your project finances into the bank and let them make the decision. They are the qualified financial advisors and they'll be able to give you the right advice. So moving on, so they want to see what's incoming versus what's outgoing. Outgoing payments are basically all the payments that you make on an everyday basis. If you have a budget, which you all should by now, if you've got a budget, you'll be able to easily explain these things to the bank. So outgoing expenses will be anything basically that you require to live. So on the board here I've put some examples. So things like power, things like gas, things like food, grocery bills. Some banks will even ask you to tell you how much you pay on clothes. Those are requirements to be able to live a proper life, and those are expenses that they expect of you. I guess what you're wanting to do with this kind of stuff is it's really good if you've got a budget, because when you've got a budget you understand what those things cost, and it's really easy for you to rattle them off to the bank or provide the bank with a budget of what you currently have put aside for those types of expenses. It also shows that you're able to commit to regular payments and regular responsibilities. So it is really handy, like I always say, to have a budget. This will help the bank make sure that you are able to meet those serviceability requirements. So I guess provided that you have that deposit and your incomings versus your outgoings kind of match, I guess, not kind of match. So I guess at this stage, if you've kind of got a handle of your deposit and you've got a really good budget and you know your incomes and you know your incomings versus your outgoings, the bank can kind of go through what you've currently got and really make a good decision on you as a client and your serviceability. But now we move on to the big question that everybody always asks: can I have debt and can I get a mortgage while I have debt? So there's two things around this. One is that if you have debt, you need to be making sure that you're able to meet your payments on your debt currently, and that if you're not actively trying to get ahead or to pay it off, that those debts aren't negatively affecting you. If those debts are having a negative impact on you, minimizing how much you're saving for that deposit and paying off that debt first. There are a few reasons why I say this, and this is personal opinion, please remember that, is that your debt accrues interest at very high interest rates. You'll pay more if you save and pay it off slowly than if you just paid it off and saved afterwards. The reason for that is because you do pay interest rates on debt, and that's the thing that people forget when they've got debt, is that with debt comes an interest rate, so I'm paying more than what I'm actually borrowing. So yeah, I still recommend to most people that you find a way to save at a minimal, whether it's $5 or $20 a week, whatever that might look like, but you are still meeting the requirements of your debt as much as possible. So in terms of a bank approving you based on your current debt, it does again come back to your incomings versus your outgoings. The bank wants to see that as a lender you're able to meet all those requirements, and if you are purchasing a house that is potentially under your maximum borrowing limit, you might be able to consolidate all of your debt on your mortgage and borrow more, provided you're still under that cap, to be able to cover you. So in terms of debt in your current situation, I do have a few recommendations. Not everyone's will be the same, and not everybody's opinion will be the same, but this is what I would recommend if you do have debt and you're trying to get ahead. So other than understanding your number, it would be making sure that if you are struggling with your debt, don't ignore your lenders. So if they are trying to call you and they are trying to contact you, answer that phone. Lenders do, they want your money, but they also really appreciate people who they can talk to and understand your situation in. If you've got a budget and you're working towards making your financial situation better, my recommendation would be to call whoever your lenders are that you are behind with, sending them your budget or letting them in on understanding what your payments look like, so that you can let them know that, look, I know that I will be able to get ahead of these payments if I make this regular payment. Can you allow me to do this for this long, and by this date I'll be ahead of my payments? You should be able to work that out based off the sorted calculator. It shouldn't be hard to do that, but it will take a while for you to work that out. But don't ignore lenders. If lenders are calling you, and those are those unknown numbers that I know you don't want to pick up, but if lenders are calling you, don't ignore those calls. They are really important that you answer those calls and that you're able to explain to lenders basically what your current situation is and how you're going to get ahead with them, because it will keep you up at night if they're calling you every day, all day. I know it used to keep me up, and I used to cry and stress about it. But once I'd done my budget and I felt comfortable with talking about my finances, it was easy for me to call them and say, look, I'm actually going to make this regular payment once a week. And after the first 4 months of me making this payment, I promise I'll be up to date. The other thing that I did was I worked out all my debts in terms of what was causing me the highest amount of interest if I paid it off slower versus what had no interest, and I actually put the no interest payments last because obviously it wasn't accruing interest, so I could still make the minimum payments and be able to meet the requirements, but I wasn't going to be charged extra. And then what I did with my highest interest debts is I paid them off first. Some of them were the bigger debts, and it did mean that I got my wins in terms of paying off my finances a lot slower than others. However, it was worth it because I paid a lot less interest over the long run. I basically worked this out from the sorted calculator, and understanding what my debt numbers were helped me work out what I needed to pay off first so that I could save the most money in the long run. So in terms of debt and mortgage, there are some key things, I guess, in terms of success to help you pay off these debts. Recently on Radio NZ, there was a wee talk about people purchasing homes and having debt. And that some of them, most of the home buyers that do have debt did have the amount in terms of a deposit to meet the requirements. However, because of the debt, weren't able to borrow. So for me, understanding what your debt number is really, really important. And when I first started talking about this on Instagram, I did talk a lot about knowing your number, and that's why my husband and I shared our number, because it was really, really important for us to help people realize that the only way that you can hold yourself accountable and empower yourself to get ahead from your debt position is to understand your number. So in terms of debts and mortgages, it's really, really important to know your number. Knowing your number helps you set a goal in terms of how you're going to pay off a debt, how quick you can pay that debt off, and how much or how little interest you can pay off over a certain period of time. So I had a Gem Visa card. I had borrowed $2,500 3 years ago. It had a 25.99% annual interest charge. And so what I've done here is I've shown you two ways that you can show yourself on the www.sorted.org.nz debt calculator what your interest might look like over a period of time and what the minimum payment per week would be to pay it off. If you paid $30 per week, that would take you 25 months to pay it off, and you would pay an interest of $742. The total paid on the amount you borrowed is $3,242. If you paid an extra $20 a week, so if you could afford it, if you paid an extra $20 a week and paid $50 per week, you would pay off this same amount in 14 months and pay an interest rate or pay interest of $384, meaning you would only pay $2,884. So you can see here by working out how much your minimum payment might be per week. You can then see how long it will take you to pay it off and how much interest you'll be paying over a certain period of time. This helps you set a goal. So say I wanted to buy a house in 2 years' time. I know how much debt I have. I know the interest rate. I can now work out how long it would take me to pay it off, how much I need to make for minimum payments, and how much interest I'll pay on that amount. And when you put it like this, it's really, really easy for you to set goals, because then you're able to either increase those minimum payments each week, each fortnight, whatever you're able to afford, and you're able to put more money onto that debt to pay it off a little bit quicker. If I was you and I was looking to buy a house but I had debt, the first thing that I would be doing, other than doing my budget in terms of the incomings versus my outgoings, I would then look at my debt and work out my total number. So I would do this with all my debt. If it was a car loan, a credit card with any other bank, any personal loans you might have with banks or with sharks, with loan sharks, anything like that, working out what the total amount is, putting it somewhere visual and working out how you're going to pay it off. And if you can make extra payments, checking with those lenders what those extra payments might look like, because just remember, sometimes if you pay a loan off early, or if you do pay extra onto a loan, they may charge you fees. So you don't want to pay fees on anything, because you're already paying fees, and the last thing you want to do is add to those current fees. So check with your lenders, understand what your debt amount is. It's really important that you look at that, because we are going to do that later on. I'm going to show you how to work out again the interest on a mortgage that you might take out, and this will help you with some other tips and tricks through the house buying process. So the last thing that I want to talk tonight is about credit checks. So credit checks are really important, and I'm only bringing this up because I've had questions about it before, and whether credit checks will affect borrowing if you're wanting to look to buy a house. Yes, it will. It can. Sorry, not yes, it will. Yes, it can. In terms of credit checks, there are two ways that you can check it. One is like the most credible way to check it. It is free and it takes 20 days. I'm sure that there are other ways, but I'm just going to talk to you about the free ones. So this one here is through Equifax, and I've just put the link here. It's http://mycreditline.co.nz. You do have to apply, and it takes 20 days to get that credit check done. But from memory, this is the place where all lenders and banks and stuff will check from to see what your credit history looks like. So your credit history lasts for 5 years from this year, so 5 years back. And basically it will show up any defaulted payments that you might have made to lenders, any times you've been sent to Bay Court for certain things, any times you've borrowed, any times you've looked at borrowing. So even if you've just applied to borrow, anything like that will show up on here. Yeah, if you use Equifax, it's free. It does take 20 days, but it's worth the 20 days. 100% apply now. If you're looking for a quicker fix to reset anxiety, if you're anything like me, then Credit Simple. So I'm pretty sure they're just www.creditsimple.co.nz. You can go on their website and you can check your credit number. Basically, your credit score is a number between 0 and 1,000. Anything over 500 is pretty kapai. Anything under 500 is, a little bit questionable. So 0 basically means you have the worst credit history ever. If you've got a credit history at 0, you really need to work on how you can build your credit history back up, in terms of I would never borrow again, and I would make sure that I was servicing everything that I had to and cutting back on any expenses that weren't necessary to make sure that I'm not defaulting on payments. And I don't really joke about this stuff, because credit histories can affect you getting employment. It can also affect, you buying a home. It can affect numerous things in your life that you wouldn't ever expect it to, and it can make it really hard. It can also be something that isn't your fault. So I know people, and this is probably a bit of a touchy subject, but if you've been in a pretty abusive relationship, or you've been in a relationship that's gone sour quite quickly, and you borrowed something together, or someone's borrowed something in your name and you didn't know about it, but because you're together, maybe it's just happened, that can cause your credit history to go quite south quite quickly. So my recommendation in terms of things like that is, knowing your knowing your credit score can help you have conversations with banks and things like that about your history. It can prepare you and help them understand that if it was bad, why was it bad, and if there was a pretty big reason for that one blemish, then how can you get past that and prove to the bank that you can service a debt and that serviceability can't be questioned. They can still question it, I guess, because it is your credit history and your score, but hey, you can always try and have that conversation with them. Anyway, moving on. If you have a score between 1 and 300, it probably means that you've defaulted on a payment somewhere along the way. You potentially could have gone to Bancorp, and so there could be like some issues around things that you've done. You might just have a poor payment history in terms of you pay things late all the time. Those types of things can affect your credit history if lenders start reporting on it. If your credit score is between 3 and 500, you're slightly below average. You probably don't really have much negative, you probably don't really have much negative things on your file, but you might be of a younger age, you might just not have built up your credit history yet, they might still be working on it, or you may have defaulted a few payments. So yeah, those types of things can make you sit in that area. If you sit between 500 and I think it might be 700, actually maybe I'll just check. If you sit between 500 and 700, then basically you are an average borrower. You borrow, you're able to pay, you have a pretty average credit history. You may have a mortgage, you may be a little bit older and have had some experience in the credit world, so that stuff there can play out there. And if you've got more than 700, well, good for you. My credit score isn't above 700, that's for sure, but it's definitely not below 500, so car pie me, and I'll be open about that, and that's about it that I'll be open about. But yeah, pretty easy. So just to recap on tonight's little episode of debt and serviceability, the bank wants to check a few things. So firstly, they want to check your incoming versus your outgoing expenses. They want to make sure that when you get a mortgage, you're able to service what you still currently have in terms of your outgoings, plus add your mortgage onto that, and that you've got enough incoming to be able to pay all of that off. Secondly, your debt and mortgages. What the bank wants to see is that you don't have too much debt, you're not a serial borrower, and that you're able to manage those payments really well, service them properly, and it is more positive to not have debt when buying a house. But I know my husband and I, when we first bought this house that we're in, we did have debt, and it wasn't an issue then. However, we never defaulted on payments, and we were pretty good at paying things on time, even if it was the bare minimum. And when we did buy a house, we consolidated a bit of debt at that time. Didn't stop us from borrowing more, obviously, but it should have. And that's the mistake that a lot of people make, is that you think that when you borrow a home and you consolidate your debt, that along the lines you can borrow more. My recommendation would be use it as a clean slate if the bank allows you to do it, and don't do it again. And then lastly, credit checks. So make sure you do a credit check at some point in your life so that you basically know where you sit, and you're always on top of that. The last thing you want is to find that somebody else has borrowed money using your name and ruined your credit history. Yeah, that's the last thing that you need, and that can happen. So being on top and understanding your credit history is very, very important. And if you've had a bad credit history and had a few blemishes along the way, and the bank does question you, if you know what your credit history is, on there you can basically see everything in terms of your borrowing history. You can take that with you when you go to get your mortgage and talk to them about those things as well. It's really good for you to be open, honest and vulnerable with the bank, because it shows that you are, one, on the right track to making sure that you can be good at serviceability, and two, that you understand your finances. So yeah, that's it from me tonight. Hope you guys enjoyed tonight's episode, and hope it added some value somewhere. Make sure you budget and know your debt number.